Well, now as borrowing costs are certainly rising, it is something that we should be addressing, and we need to consider when buying a home. Hi everyone, this is Tim and I'm a mortgage broker in Arizona and Colorado. I've been doing real estate and mortgages for over 16 years now, and I work in the industry daily. So let's start talking about the current real estate market, and then we're going to look at some of the fundamentals of real estate, and then we'll put together a live deal right here so we can look at some numbers, and we'll see if buying a house right now even makes sense because the numbers are so out of whack. Then we'll figure out a strategy that fits for someone that does definitely need to buy a home right now while rates are high and home prices are high. All right, so how did we get here? So let's start back in 2008. Actually, we'll start all the way back in like 2002 and 2003. See, Congress, they wanted to push for bills that would allow for more home ownership for Americans. Well, we've always sat right around the 65% range, and they really wanted to push that and push it and push it. And so they kept lowering the standard of the loans, right? Until eventually they got to a point where home ownership was all the way at 69.1%, which was 4.1% higher than the average has ever really been, okay? So we peaked out in 2005 when we hit that total of 69.1% home ownership, which, like I said, that's an increase of 4.1%. So you might be saying, so wait, Tim, a 4.1% increase in home ownership. That's not really that big of a number. Well, let's break that down. Okay, so there's a population in the US of about 329 million people, and just 4% of 29 million people is 13,180,000. That's a lot of households. So then what happened? Well, let me pull up a chart right here, and this shows the housing starts. As you can see here by looking at this chart, we got to a point where in 2005 they had 2.2 million new housing starts. Let's zoom in a little closer to this 2005 era. We'll go ahead to 2016. All right. So here is the recession of 2001, and you can see how getting towards 2005, things were just building up and the housing starts were booming. And as you can see, they got really, really high. As a matter of fact, they got all the way up to 2.2 million units for the year. Well, then the housing crash started. And this is what a lot of people get wrong. I hear a lot of people tell me that recessions cause housing to go down because this recession that happened in 2008, this gray area that we're looking at here, it was caused by housing. The recession didn't cause housing to go down. I think that's super important to understand and realize. All right, so you can see that the builders started dropping. In 2009, we had 490,000 home starts, and that's it. And since then, we haven't had a lot of building. We haven't had sufficient building, not for what we need as far as supply goes. Okay, so now I'm going to pull up another chart that I want you to see that shows the total US inventory, and this is from Trading Economics. And here is the total, here's the total housing inventory in America. And as you can see here, during the 2008 era, the 2008 the Great Financial Crisis 1.0, we'll call it. Well, during this 2008 era, we had all of these houses that were probably sitting empty because we built too much, right? But you can see as we stopped building, that housing inventory just kept declining to the point where it's still at almost the all-time lowest record ever. Okay, and that's just something to keep in mind when people are saying that we're going to have a big crash, because if we do have a big crash, it's probably going to look more like the 2018 crash, less like the 2008 bust, right? You can see that just by the amount of inventory on this graph right here. They're just at record lows. And even though they make these little bounces, they just always kind of come right back up. So there we are in the middle of 2008 and the great financial crisis happens. And the housing bubble pops, which is inflated because people would buy like 2 or 3 homes, sell them to make money, while banks and Wall Street, well, they were offering no income and no asset lending. And people even put zero money down with no income and no assets. Needless to point out, the average FICO score of the loan originated in that period was also a 688 compared to the loans originated in 2021, which saw an average FICO score of 761 per Fannie Mae. It's a big difference. So the bottom line is that while there may be a housing crash coming up, I think it's not going to mirror the one of 2008 because the fundamentals are so much different. With that being said, average interest rates are expected to go up. And they're expected to increase all the way through 2024. So I suspect that we're going to see a sharp decline in the price or the value of real estate, and it'll likely mirror the 2018 real estate crash that happened in November. Okay, well, that's 1 month we saw like a 10% decline. Okay, lo and behold, we get the Fed put in 2019, right? And a lot of you might be asking, Tim, what is the Fed put? Well, the Fed put simply means that the Fed comes in and bails out the market, right? And we've seen this now 4 times. We've seen quantitative easing 4. That just happened this last time. So you might be saying to yourself, but wait a minute. Where are the home ownership rates at now? Because maybe we're at that 60 or 70%. Well, let's take a look at that. That's important to look at as well. All right, and here from the Census Bureau, if you look here from the Census Bureau on this graph, you can actually see that the current rate of home ownership is 65.8% of America. That's a pretty healthy number. What is needed to get back to a healthy market when it comes to supply, right? Because we do need to get back to a healthy market when it comes to supply. I think we should try to help these builders get away from some of this compliance that they're dealing with. And, you know, well, then they're probably going to have a problem with even getting lumber in. So there's some issues there too. But we do need to get back to a healthy housing market. So seeing some foreclosures come in would actually probably be a really healthy thing as well. There's a lot of people that were on these forbearance plans that didn't make payments throughout the time. So where does that leave us with inventory? Well, Freddie Mac says that we're short about 3.8 million units, right? And 3.8 unit, I'm just gonna read right from the horse's mouth so I don't misquote anything, because I am a licensed loan officer. All right, as of the 4th quarter of 2020, the U.S. had a housing supply deficit of 3.8 million units. These 3.8 million units are not only needed to meet the demand from a growing number of households, but also to maintain a target vacancy rate of 13%. Between 2018 and 2020, the housing stock deficit increased by approximately 52%. Wow. Okay, so wait, Tim. You're saying that we have a lot less supply of homes, but what about the article that you just mentioned about the foreclosures? Like, they're up over 400%? Well, yeah, foreclosures are probably up 400%. But that's because there was a foreclosure and an eviction ban, meaning banks couldn't foreclose and landlords couldn't kick renters out. So we're probably going to see, let's just do this. Let's look and see where are the foreclosures compared to 2008. Because in 2008, we heard that, oh, they're up 200%. Oh, they're up 150%. Well, now we're hearing, oh, they're up 400%. Well, let's look at the foreclosure rate in America. All right, so here on Statistica, you can see that in a pretty healthy market, we can expect about a 0.5% default rate. And that was pretty consistent till 2007. Obviously, that's when they were making some of those crazy loans, right? 2008, 9, 10, 11. So you can kind of see the decline, but look here. Foreclosures in 2021, an all-time low. foreclosures are at an all-time low in comparison, especially anywhere to 2008 and 2009. So it's not even something that we can compare, right? You can compare the 440% up because we would see, like, you know, times of people going in double and triple, 200% more foreclosures, 150% more foreclosures in 2008. I remember working that market. That market was nothing but short sales and foreclosures. We were dealing with bankers on everything was late and nobody cared about the person buying the house, and houses were all in horrible condition. All right, so where does that leave us today? Are we going to see the great financial crisis of 2.0? And the answer is, well, maybe. This is what the charts are telling us. Okay, so if you can see here, the 1-year Treasury is trading right around 3.25, 3.26, and the 10-year is at 3.28. This is what they call an inverted yield curve. And this is what we always see right before a recession. You might be thinking, wait, Tim, why would I lend out my money to the government for 2.8% with a 10-year commitment when I could take the less riskier route and loan it out for 1 year and make 3.2%, which is more? Exactly. When you see an inverted yield curve, that means something is going on funky in the markets. Why would we see an inverted yield curve? Well, that would tell us that major institutional investors are seeing something on the backside that is telling them that we are already in a recession, or that we're going to have a black swan event within the next year or two. Because also, if you look at the 2-year, it's trading at 3.25. And if you look at the 3-year, it's trading at 3.19. Even the 5-year is... No, in the 5-year is more in line, because you can see the 5-year is paying a little bit more yield than the 10-year, right? A little bit more yield, not a whole lot, but you have an inversion with the 3, with the 2, and with the 1, and with also the 6-month. So that's telling us that maybe that there's a black swan event, or we're going to see a major crash. These charts, from the bond market standpoint, are just screaming recession. Either that we're already in one, or that a crash is coming really soon. Markets are pricing in a 1-year black swan event. So what happens then if we do get this one-off swan event, or let's say the market does start to take some major decline? Well, I think that we're going to get our Uncle Jerome, the rich uncle, the money printer. He'll come back into play, probably cut rates to 0, and we'll see QE5. So what does that mean for us average consumers that want to buy a house right now? Should we buy a house or should we wait? Well, that depends. There are some basic questions that you want to ask yourself first, like, what is my purpose of buying this home? Am I going to live in it with my family? Am I going to flip it? Or am I going to try to invest in it to make some cash flow, right? So it all depends on what it is. If you're going to live in it, it's a home that you want to live in, then, you know, it's okay to buy anytime. Houses will just keep going up, especially with what fundamentals I just showed you. That's where you guys have to come in, and you guys have to decide. Bring this information to your real estate team that you decide to hire, and they'll help walk you through this process. And I'd say this to them: if you're planning on buying a home and staying in it for at least a year, then it's not a bad time to buy. If you're a flipping investor, you want to consult with your real estate team, because there's much more complexity to that than with owner-occupant deals right now, okay? So like I told you at the very beginning, let's look at a live deal, and we can go out and price out this live deal and see where rates are today. And we'll take a jump over to Zillow and look at some home prices in my area, and we'll see roundabout what monthly payments are going for. Okay, so let me show you how to read this chart right here. This is basically what we call a rate stack. And what we're picking here is a conventional product called Home Possible, 30-year fixed rate mortgage. And the number over here is the interest rate. The base price is something that we deal with internally. which is called the pricing of the loan. And over here, this represents the actual dollar amount or the amount of points that you'd be paying for that correlating interest rate that's in that column. Okay, so this time we're going to try a different strategy. This time we're going to take the 10 grand that they were going to cut from the price of the home. We're going to apply that towards an interest rate buy down, or we're going to use that to pay points. Let's see what that looks like compared to the price cut of 10 grand. So you now have a 4.632 interest rate. See, here's that interest rate stack. You can see at 4.32, you're going to have a payment of $29.98. If you went in at full price, like I said, you'd have that payment around $31.90 or something like that. So you might want to say to your real estate agent, hey, rather than negotiating down the price of the home by 10 grand or 15 grand or 25 grand even, why don't you get 25 grand in closing cost concessions? That way they can pay for my interest rate. That way that'll impact my monthly payment the most and get the price drop. The best part is my CPA told me one time that this was absolutely tax deductible, even though the seller is paying the points on your behalf. So my conclusion is that while we are seeing definitely exuberant housing prices, they'll soon come down. Sometime in the next year or two, something big will definitely pop, and we're going to see a market crash. This will make the Fed more concerned, and then they'll have to step in and do more QE, probably lower the interest rates again. Well, that's all for now, folks. I hope this helped. If you enjoyed, please like, subscribe, share, comment. All right, we'll talk to you guys later. Thanks.